Hello, my name is Maria Vizupova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz. Today is February 10 and it is a weekly markets update. Let's have a look at the news of week 6 and see what are the next trends. Urea market was very bullish last week. Egyptian producers managed to increase sales price by $20 in the course of the week, conducting small sales step by step. About 70,000 tons was sold, mostly to European markets. The bullish sentiment was supported by both objective and speculative factors. Objectively, demand from Europe has increased after more than a week when customers retrieved from the market. Also, demand is expected to increase in Turkey in upcoming weeks as rains are expected, so farmers will deplete current stocks with purchases, and Iranian supply is still unavailable. On top of that, expectation of healthy demand from the US that will evolve in the second half of February and will continue in March and April adds confidence to the market players. Speculative factor was related to the news that Egypt has some gas curtailments that might influence production rates, and on the back of this news, at least $5 increase was achieved by Egyptian producers. However, this seems not to be the case, but let's watch the situation this week. Hopefully, some official comments will appear. The highest price achieved was $455 FOB Egypt for March loading. Algerian producers also increased prices, and sales happened in the level of $450 FOB, mostly to Europe as well. Black Sea spot activity was limited, as most of the volumes for February seems to be sold out. Indications increased to $420 FOB, but no actual sales happened at this level yet. Middle Eastern producers also increased their targets up to $420 FOB on the back of general bullish sentiment, and even higher, $428 FOB deal was registered for a small lot. Producers are feeling very confident with February sold out, and March volumes most likely will be in high demand due to Australian and US demand. In Ethiopia, EABC returned to the market with a tender for 300,000 tons of granular urea, with shipment window extended until May. Typically, only several lots of 50,000 each are booked in such tenders, so most likely this time it will be the same. Tender will close on February 20. Indonesian Pupuk Holdings closed its first pre tender since November, nominating the lot at $438 FOB. In the US, barge prices surged again due to feeling that there is lack of volume for imports in March, not more than same versus year ago, while demand is expected to be higher amid higher corn acreage and increased corn price. Competition for imports starts to emerge, and it will only intensify later in February and March. February barges traded at $372 to $82 for short ton, while March barges price reached $406. Demand in Brazil is almost muted. However, CFR Brazil values moved higher to $440. In the meantime, certain demand is evident in Central America, where Mexico continues purchasing for March arrival. Paper values surged again, but differently at different benchmarks. Egypt FOB showed a double-digit increase again to the average of $460 for February, $435 for March, and $420 for April. Same increase happened in NOLA, where February average jumped to $402 per short ton, March to $406, and April to $390. Arab Gulf FOB corrected upwards, but only slightly, to the average of $425 for February, $418 for March, and $395 for April. Same modest increase happened in Brazil. CFR average for February increased to $418, for March to $415, and for April to $398. Ammonium sulfate market was stable to firming last week. Chinese price for copper amsul fluctuated between $146 to $50 FOB, and granular product was sold between $160 to $65 FOB. Demand in Turkey is strong, and other Panamax from China is expected to be shipped in February. CFR level is around $180 CFR duty unpaid. European demand is strong as well, and prices keep on the high level 180 to 90 euro CFR Northwest European ports for standard product. The demand is expected to be high until second quarter, while supply will be limited due to weak demand for caprolactam and sulfate production respectively. Brazilian market is off-season. However, about 20,000 tons of copper product was sold last week at the level around mid-170s CFR. Indications for next sales moved higher to $180 to $85 CFR due to urea price rally. Demand and prices in the US increased because of threat of tariffs effect at Canadian sulfate supply. Some importers decided to enter the market earlier in order to avoid potential increase in prices. Nitrates prices in Europe were significantly increased by all key producers last week, amid increasing gas prices and rally in urea. Yara increased ammonium nitrate price by 20 euros and CAN by 15 euros. LAT nitrogen increased prices by 30 to 35 euros. Agropolychem increased nitrate price incredible 69 euros versus January. Still, the demand is strong across the markets. Purchasing activity will continue for several more weeks. UAN demand is strong both in Europe and in the US, and prices increased together with other nitrogen prices. In the US, supply is mostly unavailable already for February and also March, while demand is expected to be higher versus a year ago. Higher price is expected for the product in Q2. In ammonia market, prices corrected downwards due to lack of demand in vast majority of the regions. European production cost climbs further, but this situation didn't push demand for imports last week, so the price decreased by $5 to $575 to $85 CFR duty paid. OPZ plant in Ukraine announced that it will restart ammonia production at one line next week. However, there is no confirmation regarding gas supply yet. Moreover, port infrastructure is under constant attacks of Russian missiles, so it is not clear how it will work. Middle East market is still long, and it resulted in further price deterioration by $10 last week to the level of $330 to $50 FOB. India is expected to enter the turnaround season that usually lasts for about 2 months, so purchases will drop, which will bring more supply length to the region. In the USA, spot prices increased a bit amid expectation of tariffs effect. Spot barge was sold at NOLA at $450 to $55 level per short ton. The domestic season approaches, and market players expect announcements of higher price this or next week. The market expects that if the tariffs are confirmed, Canadian producers will pass this increase to the end consumers. But still, market sentiment is optimistic due to higher corn acreage and increasing corn prices. In phosphates, the key news came from India, which finalized its long discussion with OCP and agreed supply of 1.6 million tons of DAP and 800,000 tons of TSP, priced on formula, that will be shipped during February to December this year. The imports will be shared between different importers. For now, India increased its DAP stocks to the level of 1.1 million tons, but according to evaluations of market analysts, still will need to import at least around 2.5 million tons until end of the year to keep stocks level healthy, on top of the deal agreed with OCP. Ethiopian ABC issued another purchase tender for 540,000 tons of DAP that will close on February 20, together with the urea tender. Under its previous December tender, ABC confirmed around 300,000 tons of supply in total. OCP reported sales of around 60,000 tons of DAP to various European markets for loading in February and March at the higher price level versus previous sales, $5 to $15 depending on the destination. In Brazil, the activity was limited, but purchase window for 25-26 season soybean will open soon, and farmers start asking for the product. For now, MAP prices are stable at $635 CFR. In the US, market activity picked up again because of fears of tighter supply due to tariffs. At NOLA FOB, prompt DAP traded almost $10 higher versus a week ago, at $588 to $600 per short ton. MAP price also firmed, but to the level a bit lower than DAP. In India, Finance Ministry has presented fertilizers budget for the next fiscal year. The overall funding for urea subsidy plus nutrient-based phosphate and potash is down by 2% versus previous year. Subsidy for urea remained unchanged, while funds for phosphate and potash subsidy were decreased by 6%. There is no detailed info regarding how funds will be split between phosphates and potash, yet at least. Let's watch this situation further and see how it might influence demand for these products. Moving to the fundamentals. European natural gas futures increased significantly again to the level of 56 euros per megawatt hour, as colder weather drove up demand and reduced gas reserves. Temperatures in northwest Europe are expected to drop, accelerating inventory depletion. Currently, European gas storage stands at around 51% capacity, down from 69% a year ago. On the supply side, Norwegian gas exports have increased following the completion of maintenance at one of their fields, while LNG send-out remains steady. Meanwhile, traders are closely watching trade tensions as China imposed a 15% tariff on US gas in response to Trump's tariffs on Chinese goods. US natural gas futures increased by 10% during past week to the level of $3.3 per MMBtu. The increase was driven by higher LNG exports and colder weather forecasts, which are expected to boost heating demand. Gas flows to LNG export plants also increased in February, nearing December's record. Looking ahead, meteorologists predict colder than normal weather conditions through February 22, which will likely maintain high demand. Extreme cold in January likely prompt record-level withdrawals from storage, potentially close to the all-time high in January 2022. On the production side, February gas output in the lower 48 states has risen to 106 billion cubic feet, by more than 3% versus January. Agricultural commodities future prices were all in green, which makes farmers happy across the globe. Wheat futures climbed to $5.82 per bushel amid renewed concerns over potential trade disputes. US tariffs fueled market anxiety, and as traders worried about possible retaliation affecting crop sales. While tariffs on China did not include agricultural products, uncertainty surrounding trade policies pressured grain markets. Additionally, traders monitored cold weather in Russia due to potential crop damage. Russia's wheat export quota suggested that shipments could fall significantly next year, adding further uncertainty to global wheat supply. Corn futures rose toward $4.9 per bushel, driven by tight global supply and strong export figures. Argentina's lower corn estimate, down by 1 million tons due to dry weather, and reduced Ukrainian exports, forecasted to fall by 6.5 million tons, have contributed to concerns over global availability. At the same time, competitive feed wheat pricing in Europe and uncertainty over US tariffs are creating some volatility in the market, with broader trade concerns weighing on prices. But for now, upward trend is still there. Soybean futures fell to $10.5 per bushel on Friday after reaching a 6-month high of $10.8 earlier in the week. The drop was driven again by concerns over tariff war. Traders were also watching weather developments in Argentina, where improved rainfall helped ease concerns after a period of hot and dry conditions. The Rosario Grains Exchange reported that recent showers provided relief to the country's struggling soy crop, which had been suffering from extreme heat. Moving to the shipping industry. Containerized freight index dropped significantly by 7% last week. This is still the effect of the Lunar New Year holidays in China. Shipping activity was on mute before and during the holiday period and only will start to pick up now. Thus, more containers capacity opened that weighed on the market pricing. Market analysts expect that the rates to drop more in the short term. The Baltic Exchange Dry Index seems to have touched the bottom and started to increase last week. In Capesize segment, market activity picked up in the Pacific, but soft demand in the Atlantics and significant capacity oversupply resulted in price drop. In Panamax segment, firm demand from South America drove the market. Ultra Supermax segment saw uptick in activity after Lunar New Year holidays end. In Handysize segment, the market saw some positive movements in both basins. So, sentiment in bulk shipping started to improve in general after a long period of softening. To sum up, Urea market continued to be very bullish amid strong demand current and expected for March and April. Nitrates prices also increased significantly following Urea trend and also due to continuing gas price surge. Sulfate price corrected upward just slightly, and the gap between Urea and Sulfate price increased. Phosphates price was firm and doesn't show any signs of softening soon. Supply for DAP and TSP between India and OCP was finally concluded last week for 2.4 million tons in total for the period February-December on a formula basis. Ammonia price was softening amid lackluster demand and continuing supply length in the Middle East. European gas price increased more to record level due to significant stocks depletion across Europe. Gas price in the US also increased amid colder weather than expected until second half of February and steady supply to LNG plants. Agricultural commodities future prices corrected upwards due to concerns in terms of production in key hubs, as well as uncertainty around potential tariff war. Container shipping activity was still low, while bulk shipping picked up across the globe and rates began to increase. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.